Hello and welcome to the Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thapliyal and we have lined up a power-packed show, and here's what you should expect on the show today. First up, we will analyze why mutual funds are exiting large caps and if it is the right time for you to increase exposure to mid and small caps. We'll be joined by Nirav Karkera, Head of Research at FISDM. Next, we will understand Purpose of Money with Vinayak Sapre, author, public speaker and financial coach. And finally, on our last leg, we'll drop on the counter to get your mutual fund portfolio queries answered by Amol Joshi, founder, Plan Rupee Investment Services. So do send us your queries on our WhatsApp number, which is 8657974571. You can also email us your queries on the Money Show at etnow.tv. That's the lineup for the day, but then let's get to the top headlines of the hour. Bulls take charge of the Lal Street as Sensex hits a record high while Nifty ends the day at record closing high. Vipan Mehta of Elixir Equities expects Sensex to hit the 1 lakh mark in the next 1,000 days. Sony says it takes the SEBI order very seriously after regulators' adverse order against Subhash Chandra and Puneet Goenka terms media reports on the future of Zee-Sony merger as erroneous. Department of Consumer Affairs advises restaurants to not levy service charge mandatorily. The matter is pending in Delhi High Court even as face-off between customers and restaurant staff become a common occurrence. Elon Musk is all praise for Indian Prime Minister Narendra Modi promises Tesla's India entry as soon as possible. US President Joe Biden calls his Chinese counterpart Xi Jinping a dictator hours after US Secretary of State Antony Blinken's China visit. No reaction from the Chinese government yet. Bitcoin rallies over $28,000. Primary catalyst appears to be the growing institutional interest in Bitcoin from companies like BlackRock. So over the last couple of months, broader markets have outperformed benchmark indices, and many experts believe that this outperformance may continue going ahead. Now, interestingly, reports indicate that many mutual fund houses have trimmed their exposure to large caps. So, is it the time to bet big on mid and small caps? What are the fund managers and fund houses thinking? Let's answer all of these questions. We have Nirav Karkera, Head of Research at FISDM. Nirav, good evening and welcome to the show. So, let's list out the AMCs and funds which have exited large caps, and what kind of large caps are we talking about? Show us the data.
So Kavita, there are a variety of funds across categories. One would imagine the exodus to be majorly in the flexi-cap category. There are various funds across the flexi-cap and multi-cap category that have exited large-cap stocks. And, probably the key stocks are the ones that also saw quite some bit of run-up in recent times. To name a few, if one would look at an industry level, the key stocks that were exited would include Kotak Bank, ITC, HCL, Zomato. These are the stocks that you would also notice are the ones that have been witnessing a rally almost secularly since quite some time now. So there was a fair bit of profit booking there and some bit of rebalancing, reconstitution that has happened in most of the funds.
Right. So the kind of stocks that are we talking about are of what sector? Any bias to a specific sector that we are talking about over here, Nirav, or it's just across the board wherever they see there's profit booking?
Yeah, I would say that most of this has to do with profit booking, availability of opportunities elsewhere. A pattern could emerge, but it would be purely coincidental. I do not really see any sectoral trend in terms of exits from large cap.
So if we, for example, now the strategy for a multi-cap and a flexi-cap, if we just take these two categories, would be different. Now, if these flexi cap funds are exiting few large cap sectors or stocks, are they replacing it with another large cap, or you are seeing the exposure going increased in mid cap or small cap categories?
In fact, it is the latter, and one would notice a clear trend where there is a slow and gradual exposure being built towards mid and small cap opportunities, and this is visible across categories which have a really flexible mandate. We could talk about flexi cap. We could talk about probably value or contra funds also as in category. In fact, if we about multi-caps also, there is a fair amount of flexibility that is allowed to the fund manager in terms of expanding exposure to market caps. And we'll see a clear sense of increasing appetite for mid caps and small caps, probably tilting slightly in favor of mid caps. But yes, clearly the rebalancing is not happening back into large caps. There is some sort of shift or gravitation towards mid cap. It is very gradual at this moment. It is not significant. It is not as if fund houses have started going overweight or overboard with any of these mid or small cap market segments, but we can see a return of appetite after quite a long time, probably since almost a year and a half or over it. The most flexible mandate funds have largely been skewed and tilted towards large cap funds. So this is gradually changing.
Think a category like flexi-cap would become more volatile if there is the increased exposure in mid-cap or small-cap? How would you explain this to our viewers? I mean, primarily we see that a lot of flexi-cap are large-cap biased. Not necessarily that the fund is changing the kind of theme or the tone that they have decided on, but in terms of volatility, in terms of their risk profile, risk appetite, how would an increased exposure in mid-cap and small-cap change further on?
Right. So an inclusion, or let's say rather an increase in exposure to mid and small caps could make the overall portfolio of flexi cap funds slightly more volatile than it would be if it was heavily skewed towards large caps. But at the same time, one must understand that only those investors are supposed to invest in flexi cap funds who are basically trying to outsource their optimization decisions to the fund manager. So there are investors who try to optimize for their own risk profile and their investment profile. They clearly choose between a combination of large, mid, and small cap funds, pure play ones. But for those who want to optimize market cycles and want to optimize for valuations and opportunities in every segment, it is best to leave the decision to fund managers. So a fair bit of volatility is obviously expected. In fact, it is not just on account, obviously it is on account of mid and small caps, but even if you see from a longer duration standpoint, and if you consider the very essence of flexi cap funds, the essence of volatility is built in, inherent. Lesser volatility due to large cap skewness could be a coincidence that at that point in time, the funds exhibited lower volatility than most other, but it would be attributable to a coincidental point in time wherein the funds were less volatile. So, long answer short, will the volatility increase on account of increased exposure to mid and small caps? Definitely yes, because by nature, the mid cap segment is viewed as slightly more volatile than the large cap segment, and small caps being far more volatile than the mid cap.
Nirav, any clue on what kind of mid cap and small cap are being added in terms of sectors or specific stocks, if you know any?
So there are a few, mid caps that are being added, but I wouldn't as much say as a sectoral pattern is emerging. In fact, the best thing about most actively managed mid cap and small cap exposures is that most stock selection processes are bottom up, and the sector is basically an output or a byproduct of the investment decisions that are made. So the migration that we are observing into the mid and small cap segment are more so sector agnostic, and has probably nothing much to do with a specific sector doing well or not. In fact, the mid and small cap segment also offers opportunities in a very disparate or a set of pockets, right? So it really depends on how wide do you cast the umbrella, and how wide do you bucket into a certain segment. But any of this would be merely a byproduct of the bottom up stock picking that has happened. So no sector trends emerging there.
So, Nirav, now the question is now funds and fund manager exiting large cap, increasing the exposure in mid cap and small cap. Does this also translate in an individual's portfolio strategy? Time for them to increase exposure, or maybe even the SIP amount in specific mid cap and small cap funds? Can an investor take that step?
Yeah, so Kavita, there's one thing that I've noticed that there is also coincidentally an inflow into pure play, an increased inflow into pure play mid and small cap funds at this point in time. So it happens so that investors are already in aggregate following a similar trend wherein there is more money being diverted towards mid and small cap plays, like most fund managers are doing with flexible mandates. See, one thing is for sure that it is only when there's a storm that the value of a ship is really appreciated. But as soon as the skies clear, everyone's looking to hop on a speedboat. So historically, it has been well established that mid caps and small caps have the potential to outperform large caps. So and now is the time where things are really lining up. Stars are really aligning for the mid cap segment and the small cap. Obviously, later on, slightly below mid cap, because of a couple of reasons. The markets and the broader economy is entering an expansionary cycle. We are staring at an investment cycle uptick happening right in front of us as we speak. There are many market leaders available in the mid cap space, small segment leaders available in the small cap space who were troubled by macroeconomic headwinds. But now that the skies are clearing, now that the macroeconomic situation, the macro blur is sort of clearing out, there is a whole lot more visibility on the growth potential. In fact, post pandemic, we saw many mid caps and small caps being downgraded, and now we have moved into that part of the cycle where the downgrades are slowly and gradually flattening. The pace is reducing. We expect ourselves to be at a cusp of a reversal in this trend. Probably a couple of quarters or a financial year down the line, we would see a series of upgrades happening in the mid and small cap space. So with all and the most important thing, valuations. If you look at since most investors base their decision on relative valuation, you look at the 12-month forward PE or price to book, it has been clearly coming off of the peak. It is not quite towards the mean. It is not quite at the mean, but it is fast approaching the mean, which indicates that the valuations are looking slightly more favorable than it was a year back from now. So the stars are aligning. There is more, visibility, more clarity on the macroeconomic situation, and there is an increase in the appetite for among investors generally and fund managers generally. So if anyone's investment profile and risk profile does permit to do so, now may be a great time to start increasing exposure to small and mid caps, especially in the satellite as portion of their portfolio. That nothing changes for the core strategy, but within the satellite, if now could be a good time to start tactically going slightly proactive with allocating to mid and small cap stocks. And one needs to do it really selectively. A word of caution there for those investing in stocks directly, it is not an uptick that we can see in a developing in a broad based manner. It could be in select pockets and select opportunities. One needs to be careful about it. At this point in time, we would probably look at actively managed funds as a close alternative for those who do not want to go through the stock selection process. And we would place an actively managed mid and small cap fund even higher and above passive opportunities, having exposure to the same segments.
That was quite an elaborate answer and also a good explanation for investors whether they want to invest through mutual funds and mid cap or small cap or want to go through direct equity. But also for people concerned about their large cap fund performance, you think it's time, if your fund is not performing since couple of quarters now, you figure out an exit route and maybe try going for a passive strategy in a large cap space?
Yeah, so I would say, to answer the first part of the question, there may not be a need to immediately cut exposure to large caps because large caps are typically the anchors that one holds in one's portfolio. Unless one wants to be extremely aggressive or extremely tactical with their way of portfolio management, I feel that large caps still deserve a very solid position and allocation within one's core portfolio. So there's no reason to really move out of large caps. But yes, Kavita, as you rightly pointed out, passives are quite an interesting opportunity that has surfaced over the past couple of years, and it is a really efficient way to take exposure to large cap stocks, especially now. When there's a lot of opportunity coming up in the small cap and mid cap space, and knowing that large caps will continue to do well, and it does deserve a allocation in the core portfolio, it might just make sense to allocate into large caps, into passively managed, into passive large cap funds, which are basically tracking the large cap indices. It could be a far more cost efficient manner so that you manage to get those extra returns through lower cost and through more efficient tracking of the indices. So in fact, there's a whole lot of opportunity for the broad-based index also that stands to benefit from any sort of basket buying that happens, or inclusion of the index package into foreign portfolios. There are certain tailwinds also attached in benefit and in favor of indices. So this could be an additional benefit to opting for a passive fund in the large cap segment.
That's a solution for you if your large cap fund is not performing, and also right time for you to maybe have an extended strategy in mid cap and small cap. Thank you so much, Neera, for being on the show and helping our viewers with that today. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Money can mean different things to different people, but sometimes the greed for money can actually overtake your desire to lead a sane, balanced life. You can soon be trapped in a vicious circle where money is all that matters. Therefore, it is essential to understand the real purpose of money in one's life. And to do that, we have on board Vinayak Sapre, author, public speaker, and financial coach. Vinayak, good evening and welcome to the show. So, somewhere down the line or in the midst of everything in life, we all know the importance of money, the relevance of money. We might not know the importance and relevance of investment, but then yes, money is essential. We all know that. But then, is that enough to live a good life? Is the bigger question.
Yes. So thanks, Kavita, for having me on the show. A very good question I keep coming across, and at times when people don't ask this question, I actually ask them that what will you do with your money? Because it is very, very important to understand the meaning of your money and what is the purpose of generating that, creating that wealth. So it is definitely essential, but it may not be the most important thing. Because the most important thing is the happiness quotient you can make out, and you need to have very high clarity that how will you enjoy that money. And if you allow me, I can recite a doha of Kabir where he says that Kaudi kaudi jod ke jod bharela thela, kahat Kabir suno bhai sadho, sang chale na thela. What does that mean is, if we keep on we keep on chasing the money. Just to give you an idea, I think there is a data about PPF wherein it suggests that more than 80% of PPF maturity goes to the next generation. So people don't know what to do with their money. So people can do many things where they can make their life meaningful by using their money properly.
Also, Yeah. So also one very important thing is even if people think that money is their life, they don't really know how much is enough. You know, this fight and this run for having enough of it is just never ending. So I think it's a vicious circle that we were just talking about earlier.
Yeah. So again, very important, and thank you for asking this question. Somewhere down the line, people need to have the clarity that how much money I need, wherein I will have an financial freedom and not the retirement, so that I can pursue and my hobbies and passion, whatever hobbies or passion I have. For example, if to take my case only, so I do a lot of programs called charity, you can say charity in the sense pro bono programs, wherein I do Paise Ki Pathshala or Investor Ki Baat Kabir ke saath, wherein that is my passion to reach out to the people and make them understand the importance of their money. That they should not chase the money, rather than should enjoy that money. So my uncle used to ask me, "Who says enough is enough?" But there is a line you can draw when you are actually creating that wealth.
All right, but then now when we are talking about when we are explaining viewers that money is not your life, so how to identify these important pillars in your life of which money can be part of? You know, happiness is definitely a bigger goal in life, but then what should be the overall strategy, and how can money be like an addition or maybe complement to that entire goal of happiness?
Uh, okay, so as I said, once you decide that how much money I need to pursue my hobbies and interest and passion, once that is defined, thereafter you can. I'm not suggesting that people should not earn money, but they should earn money by where the condition is there by their choice, and I think that is very very critical to know, and one can definitely uh, look inward and think that, okay, what all things I can do other than doing my mundane job or the things which I am doing currently, and thereafter people will start getting the answers to their question. But definitely focus should be on achieving the financial freedom first, and thereafter what needs to do for the society. At times, if people are interested in doing something for the society, or as Kabir says that uh, he recites the Doha, and he talks about that the life should be Kabira hum paida hue, jag hase hum roye. When I was born, people were laughing and I was crying. ऐसी करनी कर चलो, जग रोए हम हंसे जग रोए. That people should, whilst living this world, people should not have any regret that my life was not meaningful. So it is very very essential to identify that what is my strength, and where I want to, in which area I want to work. That is essential to know.
This means one step at a time. You have to first figure out the primary goal of money that you need to align your goals with, and to walk the path of financial freedom, it's very important to know how much is enough. When we talk about volatility, and when we talk about the fear and greed factor, which a lot of investors and in fact even traders have, what would you like to advise to the kind of mindsets or the kind of fear that's there in their mind whenever they see volatility in the market, or when they fear losing all of the wealth that they've accumulated?
It is easier said than done that follow your dreams, or life needs to be meaningful, but there is so much of noise around us these days, whether it is social media or of influencers or the friends, for example. So and the peer pressure. So one needs to detach himself or herself from this noise and need to have a lot of clarity as I said, it is easier said than done. So you need someone who should keep bringing you back on the track. And it is good to have a coach in that case. Nindak niyere rakhiye, angan koti chhawaye. So somebody should challenge your belief system, and who should help you focusing on your goals. That is important. Life goals, not the money goals, life goals.
All right, I think that will be all. Thank you so much, Vinay, for being on the show and helping our viewers in understanding the real purpose of money and, in fact, financial freedom in their life.
Thank you so much. Thanks.
We'll take a quick break, but then post that, let's discuss about your financial portfolio and let's get your mutual fund queries answered by Amol Joshi after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, there are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help navigate through this maze? Now, we have on board Amol Joshi, founder, Plan Rupee Investment Services. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Hi, Amol. Good evening. And we have our first viewer online. Nitin Pagare wants to ask you his question. Hi, Nitin. How are you doing?
I'm fine.
You're calling from where?
I'm from Mumbai now, right now.
Okay. So, Nitin, do you already have a financial portfolio and you want to know about adding a small cap fund, or you are just beginning your process of investment?
I already have a portfolio.
Okay.
I'm investing in 2 large cap funds, 1 small cap fund, and 1 value fund. That is UNESCO Contra Fund.
So you have 2 large cap, you already have 1 small cap, and you have 1 value also. So you already have a small cap, right? You want 1 more small cap?
Yeah. I'm investing in SBI small cap. Just now, and I want to add a small cap fund.
But you already have a fantastic small cap fund in your portfolio. And apart from that, you have 2 large cap and you have 1 value. I think a good diversification is strongly recommended. But then, are you open to opting for some other category, or you really want to stick to a small cap?
I'm open to other category also, but I think the small cap gives. I'm interested in investing for 5 years, more than 5 years. So I'm thinking of it.
Perfect. That's a good clarity we got. So Amol, over to you. So he said he has 2 large cap, he has 1 small cap and 1 value fund. What about suggesting him some other category fund, or you think that sticking to a small cap is good for him?
All right. So good evening, Kavita. First and foremost, when you, Mr. Nitin, when you already have 2 large cap funds with 1 small cap fund and 1 value fund, I would suggest that small cap allocation probably is close to 25%. Even if in a simple manner, if I take an equal allocation across all these 4 schemes. So I would say 25% allocation to small cap is a good starting point. And especially given that your horizon is around 5 years or 5 years and slightly more, if you had horizon of 7 to 10 years, preferably 10 years more, there was still some sense adding 1 more small cap fund. But I would say that if your horizon is about 5 years, then 1 small cap with 25% exposure is a good enough exposure, is a good enough allocation. Coming to what Kavita suggested, you could be open to looking at other categories. I would suggest if you are looking at adding something towards the mid cap, you have 2 choices from my side. You can look at HDFC large and mid cap fund, where you will get some exposure to mid cap. Or if you want to look at purely mid cap, then Motilal Oswal mid cap fund is also another scheme that you can look at to supplement your existing 4 schemes. At the same time, Kavita also mentioned about the diversification. Unless your portfolio is really large, I would suggest these 4 schemes, or at max 5 schemes, would do a really good job of constructing a portfolio for you, especially if you look at the annual rebalancing or annual portfolio evaluation. It is not necessary to go overboard in terms of adding number of schemes to the portfolio.
Fantastic. Nitin, are you there on the phone line with me? Did you hear? Yeah. Tell me.
Yeah, I'm there.
Anything else you want to ask?
Yeah, I wanted to know which of this quant or axis, which is the good small cap fund.
Right, Nitin. So that was your main question, which is a good small cap fund. Out of you have picked up, you have selected shortlisted 3 schemes: Quant, SBI, or Axis. Quant has delivered a very robust performance over last several years across all time frames. Similarly, Axis has also done well. Within your given choice, I would suggest Axis small cap is probably better bet in all the 3 funds that you have shared with us.
So much, Nitin, for sending us your query. But then, Amol, this is a time where a lot of investors are gaining interest towards mid-cap and small-cap category. Sure. How should they analyze the best mid-cap and a small-cap fund for their portfolio? Just in case they don't have it. And if in case they already have one, they should maybe look at increasing their exposure or their investment amount. Or if the fund is not performing, they might want to just exit also. What should be the call?
Right. So in the previous answer, we also mentioned about the annual rebalancing as well as annual evaluation of the portfolio. Weekly or monthly is not a very good time frame. You should look at your schemes, how they perform, especially on 2 parameters. First parameter is how the scheme is doing compared to its benchmark. Every scheme has a benchmark. And second parameter is how the scheme is doing, particularly with the compared to the category average. Based on these 2 parameters, now many times schemes also go overweight or underweight on a particular sector. And if that sector does opposite of what the fund manager is thinking, then you will also get a performance setback. So you will have to evaluate multiple parameters, but starting with comparison with benchmark and starting with comparison as a second point, comparison with category average are the good screening criteria for your annual rebalancing and for your annual review.
All right, let's move on to our next question. And this is an email from Mr. K.S. Srinivasan, and he plans to invest 5,000 rupees per month in a diversified fund for 10 to 15 years. And we don't have him on the phone line, but then he wants fund recommendation for the amount of 5,000.
Right. Kavita, as you know, all the conversations that we have, we would really like to know. Investment horizon is definitely given by Mr. Srinivasan, so that's a welcome help. We would also have like to know what kind of investor he is in terms of risk appetite, whether he is an experienced equity investor or first time testing the waters in equity. But let's assume that since he has asked for a 10 to 15 years kind of suggestion, I would suggest he has a slightly aggressive kind of a scheme in his mind. So first and foremost, a 5,000 rupees SIP over 10 years will generate about 11 lakh rupees of corpus for Mr. Srinivasan, and same 5,000 rupees SIP, if he holds on for 15 years and if it generates 12% kind of CAGR, the corpus would be about 24-25 lakh rupees. So that's the sizable corpus. For the aggressive risk profile and given the extremely long-term horizon, I would go with 2 schemes. In a large or mid-cap fund, you can look at HDFC Large and Mid-Cap Fund. In mid-cap fund, you can certainly look at Motilal Oswal mid-cap fund. These are the 2 schemes that you can, put into your watch list and probably try to invest in these 2.
All right, that's the solution for Mr. K.S. Srinivasan. But a lot of times, Amol, what happens is, like for example, he wanted to invest 5,000 rupees.
Right.
People divide 5,000 into 5 funds. Now, an amount like this needs to be divided into how many funds ideally?
Right. So Kavita, I can certainly say with a lot of confidence that no matter what your portfolio size, if your portfolio size on the aggregate is suppose 2 lakh rupees, or even if it is 20 lakhs or 2 crores, I would suggest a portfolio of not more than 4 to 5 schemes, 4 to 6 schemes. And especially if you are starting out, and you would have noticed that for 5,000, I have recommended hardly 1 or 2 schemes. The basis of all of this is mutual fund itself is a diversified instrument. One mutual fund, we are talking about equity fund. So let's talk about that. One equity mutual fund scheme will typically invest anywhere between 30 stocks all the way to 70, 80, 90 stocks as well. If we assume for a moment that there is a 50% overlap across 3 schemes, you will still get exposure about 150 stocks. That's a decent kind of diversification to have in place, to have in your portfolio. More scheme does not mean more diversification. The instrument itself is diversified by the very nature of it. But to answer your pointed questions, for a 5,000 rupee SIP, I would suggest starting with 1 or even 2 schemes at max is probably the best thing to do. 1,000 into 5 is not going to help. It doesn't help in diversification. It doesn't help in gaining the kind of if you think that more schemes means more returns, that is also equally untrue. You would simply get the weighted average return of all the 5 schemes that generate a return for you over a period of time that you remain invested.
All right, so we move on to our next viewer's question, Vijay, and he's asking this via an email. And he says that, okay, so he sent his portfolio and his wife's portfolio. There are a couple around 40 and PPFS, PGI mid cap and quant small cap. I'm assuming it's a flexi cap fund. Lump sum of 3 lakhs put in ICICI passive multi-asset fund. Also, they have some investment in stocks, that is also via SIP, and they've got sufficient emergency fund, they've got a term cover plan on them, they've got a health cover also, and they want to increase their mutual fund SIP by 10% and stocks SIP by 20,000 every 3 years. Okay, so he wants to understand if he should be increasing debt allocation in his portfolio, good short-term and long-term options for that, and they also want to buy a house. So no, they haven't. They want to buy a house after investing in equity to their current investment maybe, and the target is to achieve 1 crore in the 11th year and 13th year from now, and 20 crore corpus after 20 years. And he also wants to take international microcap exposure in his portfolio. He wants to know about the AMC fees and should he be going into passive for a long-term period, and also if the corpus can be attained by this particular portfolio. Okay, too many questions and I think limited set of details, but then whatever we have, let's begin with the fund selection.
Right. So, Kavita, you're right. This is one of the most comprehensive information and number of questions. Almost it's equivalent of doing the entire financial planning. That would take a lot of time, but let's put our best foot forward and give it a shot. So I would say that you have selected flexi cap scheme, a mid cap scheme and a small cap scheme. And your investment horizons, Mr. Vijay, are 11 years, 13 years and 20 years. So I would suggest that just continue with this. Parak flexi cap, PGI mid cap, quant small cap, all of them are reasonably well schemes, all of them are doing good. And these would anyway be part of the shortlist that we would have suggested you. So scheme selection is fine. Shall we go to the first question, which talks about the debt to equity ratio?
Repeat, Amol?
Yes, Kavita.
I also want to understand, do you really think he should be increasing his debt allocation in the portfolio?
Right. So my opinion, I have analyzed all the numbers that he has given. They also have the Employees Provident Fund contribution, NPS contribution, so on and so forth. So I would suggest your existing equity allocation, equity to debt ratio is 3:2. As in you have 60% of lump sum into equity, 40% is debt. Given your extremely long-term horizon of 11 to 13 years and then 20 years, I would suggest 40% debt is in fact a very good debt allocation. You can probably look at increasing your equity by a little bit, but I would suggest definitely no case for increasing your debt exposure. Also, your monthly SIPs to equity and debt. Debt, I'm using Provident Fund as a proxy and NPS as a proxy. Those are also 2:1 ratio. So 60-65% debt and 35-40% 60-65% equity and 35-40% debt. I would suggest debt allocation is in a comfortable zone. No need to increase it further.
Amol, now he's saying that to invest in equity, he did not plan a real estate investment or a purchase.
Correct.
So we know how important it is to diversify your portfolio, and if at all it's a house that you are going to live in, you can have it.
Sure.
This strategy or this mindset is right?
Kavita, this is exactly the answer that I would have given. First, the pure numbers part. If you do a simple Excel or a calculator discussion on buy versus rent, rent comes out ahead because rental yields in India, most of the cities hover around 2.5 to 3%. And as of now, the interest itself that you'll pay is in excess of probably 9%. So buy versus hold, Excel discussion, buy versus rent comes out ahead. But you're absolutely bang on. In the Indian context, we also suggest our clients, our investors, to have one home, one property where you will actually stay. We do not advise second and third home or to earn the rental income out of it. But one property is definitely something that you can consider.
And what about the AMC fees, and should we be going towards a passive strategy in the long term?
Right. So, Mr. Vijay, there is no need of taking a 1-0 approach or 100-0 approach. You need not shift everything to passive, or at the same time, you need not continue to stay invested in active funds. What I would suggest is there are studies that have said that majority, about 50% or more, 50 to 60% of large cap schemes are unable to beat benchmark on a medium to long term horizon. So you can shift or switch your large cap exposure, especially the future SIPs, to an index fund where you will save on AMC fees, because that is one of your concerns. And as your experience pans out, and if mid caps and small caps continue their outperformance over index, mid cap and small cap allocation can stay in active funds, but large cap component can be switched or can be shifted to index funds over a period of time, especially starting with SIPs.
One last question. Do you think he needs to increase the SIP amount so that all his goals are achieved?
Actually, what Mr. Vijay has given, he has given us an indication that he will be increasing 10% SIPs every 3 years. So I would suggest that hardly comes to a 3% compounded. If his income cash flow allows, then I would suggest at least keep your SIP increase close to inflation, maybe 4 to 5, 4 to 6%, slightly higher than your 3% figure. Or if you are, typically my advice is, if you are a salaried employee or a professional, keep your SIPs or investment rate of increase or SIP top-up rate equivalent to your salary annual increment. So if you get a 8% or a 12% increment, then your SIPs also should go up by equivalent percentage.
So that's the solution for Vijay, but then we move on. We have Raghav Joshi from Ahmedabad online with us. Hi Raghav, good evening. How are you doing?
Good evening, ma'am. How are you?
I'm doing good. Thank you so much for sending us your question. Raghav, we have the details wherein you have Aditya Birla tax relief, HDFC tax saver, Kotak tax saver, you have Quant mid cap and SBI small cap, and you have an LIC policy also. 1 crore in 20 years. All right. So let me just go to Amol directly. Amol?
Yes, Kavita, I think this is a completely, it's a different question. I don't think we have all the details. I have details of amounts, but I would suggest from what I've heard, in tax saver segment, you can, depending on what is your basis of selection of the scheme, I would suggest for tax saver, you actively look at Bandhan Tax Advantage Fund. That's my advice. Going by your, the asset allocation that you have suggested, some amount into PPF, as long as your equity allocation is 60 to 70%, because you are building a 20-year portfolio, I think you should be well on your way to achieve your goals.
How many tax saving funds ideally one should be keeping in their portfolio?
Yes, that is correct.
Please go ahead. Yeah.
I want to close my Aditya Birla tax relief 96, and I want to invest that money in other SIP.
Okay.
So please suggest me the particular SIP that should I invest in.
All right. Amol.
Yes, Kavita, I have already suggested name of the scheme. Mr. Joshi, I would suggest if you want to close or stop your existing scheme, Birla Sun Life Tax Relief 95, you can stop that. And the next scheme, fresh scheme that I'm suggesting to you is Bandhan Tax Advantage Fund. Your 20 years goal, if you have a 5,000 rupee SIP, and if it generates 12% CAGR for you over next 20 years, then your 5,000 SIP will actually accumulate a corpus of about 45 to 46 rupees. So if you have a goal of 1 crore rupees, then probably you'll have to increase your SIP from instead of 5,000 to about 10 or 11,000 per month for next 20 years.
Thank you so much, Raghav, for sending us your question, and thank you so much, Amol, for being on the show and helping our viewers with their financial portfolio queries. On that note, time to sign off, but I'm going to leave you with our WhatsApp number and email ID where you can send us your portfolio related queries. Thank you so much for watching. Goodbye.